Fantastic. We're really thrilled to have you join this podcast. I'm really excited about this conversation. I wanted to introduce the topic before I got to introducing the guests, because I think the topic's critical for anyone in financial markets. We saw the banking panic in mid-March, and out of that came the next challenge, the next leg of potential challenge for the banks in the United States, that of the commercial real estate. We all know there's a ton of lending by the mid-sized banks in particular into the commercial real estate. And we all know there's a lot of challenges, particularly in the office space with the vacancy rates and the structural and cyclical challenges. And so I'm really thrilled to get on the show a guest who's an expert in all this stuff, works in the flexi space, works for a broad, big company with a global footprint where they broke office space amongst many other things they do in this area, in this sector of the economy. And I'm really looking forward to sharing the conversation with you, which I think was fascinating, with a lot of really good insights. We start with a quick intro, then we dig into what is flexi space, what's that all about, how's that influencing and changing the real estate market in general. And of course, it's quite important for the way it's impacting the traditional space in real estate, office real estate, and likewise. And then after that, we dig into the detail of the traditional side. What are the trends that we're seeing at the moment across the world? What are the cyclical trends, particularly in the US, UK, and Europe? And what are the structural trends as well? Because clearly both are meeting at the same time, and neither of them look particularly good for the traditional space. So let's dig in. Let's get stuck into the next Longview Conversations with. Welcome to Longview Conversations with. This is our 7th podcast. Discussing matters that are pertinent to financial markets and the global economy with experts from around the world. As hopefully you've seen, we've interviewed a ton of people across the globe, whether from Australia or Hong Kong, where they're focused on Chinese accounting and short selling, or indeed across all the way to Puerto Rico, talking about the dollar and the dollar milkshake theory. And I'm absolutely thrilled today because one of the big issues in financial markets today is the commercial real estate space. So I'm thrilled to have James Rankin on with me. Welcome, James. Pleasure.
Hi, Chris.
Pleasure to have you on the podcast. Absolutely thrilled. Very much looking forward to this conversation. James is head of research and insight at the Instant Group, which is a leading flexible workspace specialist. And I'm hoping he's going to tell us a bit more about that as we dig into the conversation about the whole flexi space and all that sort of stuff. And I think it's fair to say you're focused on bringing clarity to what is a pretty opaque world of flexible workspace and co-working that's been around, and you've been doing that for the last 5 or so years. Prior to that, you've held many positions of market analyzing, market intelligence, and different types of markets with different organizations. I think primarily in the UK. So, James, absolutely thrilled to have you on. If I've missed anything, please add it, and also please tell us about the Instant Group. What is the Instant Group? What is flexible working space?
Yeah, thanks, Chris. Well, pleasure to be here. So what is the Instant Group? So we're a company that's been around 20 years in existence, a little over. We are a workspace specialist specializing in flexible workspaces, as you rightly say. I mean, what that means is ultimately that we are here to try and help businesses really move forward faster by enabling their real estate strategy to have agility, to have flexibility. I mean, the core sort of principle that we work under or think about is ultimately, if you look at business cycles, they don't traditionally marry up with your traditional real estate lease or cycle as it stands, and therefore there needs to be a greater level of flexibility introduced to help marry or bring those two factors together, and that's what we've been seeing, as I say, for the last 20 years, but really accelerating in the last sort of decade to 5 years. A huge sort of growth in interest in flexible workspace, businesses looking to bring greater agility into their workspace portfolios, whether that's because of right sizing, whether that's because they want agility moving in and out of markets, or just responding to changing employee demand, which is one of the big factors that we're seeing today in the market.
Yeah. So let's sort of really get back to the basics. You've touched on it and half explained it, but exactly what is flexible workspace?
Yeah, so flexible workspace encompasses a number of different solutions within the workspace market. ultimately, it's solutions that normally are all-inclusive from a cost perspective. They normally require very limited capital expenditure or capex. They're normally pretty short-term in terms of the lease or the agreement, the contract, and it means that really a business can take on space, whether it's their own, as in branded in their own format, whether it means they have their own floor. All right down to individuals that are taking on co-working, so working in mixed use environments with true flexibility, day to day, week to week, right up to larger companies and teams that are looking for, as I say, their own maybe private space with their own branding, but with those key attributes that I previously mentioned. And normally that will be within a lease term or a contract of 2 to 3 years at the top end.
Yeah, I suppose it's worth saying as well for people that aren't familiar with the British traditional commercial real estate market, and actually you must let me know what it's like overseas, but I know certainly in Britain that historically people take office space lease rents for 5, 10 or longer years, and it's sort of upward only rent review, and typically you're locked in for a long period of time. But the flexi space is obviously, as you say, you come and go as you please, as long as short lease as you want. So it's really challenging. It's challenging the historical norms, certainly in the UK. Is that the case overseas as well?
It is to a certain extent, slightly less so in markets such as the US, where lease lengths tend to have been slightly shorter. Also, the landlord or asset owner traditionally has been maybe slightly more engaged with that occupier, possibly because of those slightly shorter lease lengths. But I think that the key element that I sort of didn't mention earlier that sort of flex tends to embody is a closer relationship between the provider of the space and the occupier. So there is much more of a continuous sort of feedback and theoretical improvement, rather than a case with a traditional lease where you may get the keys, you fit that out to your own specifications. You may have some sort of limited contact with your landlord or asset owner during that period, or your leasing agent, and then at the end of it, you sort of hand things back. So traditionally within Flex, then what we've certainly been seeing is there's a much closer relationship there, which allows both negatives and positives to be fed back and forth and reacted to far quicker.
So just to be clear, correct me if I'm wrong, but Instant Group is more involved in the broking of the flexi space rather than the ownership of the flexi space. That's probably doing you a slight disservice. I'm sure it's a broader, all-encompassing, but you're not a WeWork or a Regis as sort of typical.
No. I mean, we ultimately work on behalf of our clients. So if the client's coming to our business, the occupier, and looking for space, we ultimately are looking to provide them with the best solution that meets their needs, whatever that may be in the market. So, we as a business, I think, are the largest global digital brokerage firm for flexible space. So we have a huge stock, effectively, or a mix of space that we can put occupiers in. If that space doesn't exist for whatever reason, or isn't quite right, then we do provide a service where we can deliver space on behalf of the client, bespoke to their needs, and we do that at a global level. UK, US, APAC, through EMEA also. So we do offer both solutions, but it comes down to what is the right solution for the client and the occupier, and making sure that they get that service they need.
Yeah. So whilst we're on the flexi space, before we get to the sort of the traditional space, what would you say the current trends are? I mean, we were chatting a couple of weeks ago about this market, and you were talking me through the demand and supply dynamics, and I think you used this wonderful oil tanker versus speedboat analogy. Talk us through that. I thought that was great.
Yeah, I mean, ultimately, if you look at flexible workspace as a sort of percentage of total commercial real estate, certainly office space, it's still relatively small. The penetration rates in the UK, for instance, are probably around 7%. That's probably the most mature market globally. Similar maybe in somewhere like the Netherlands. In the US, you're probably close to sort of 1.5%, going up to sort of 3% in the major US cities, and you then get the whole variance between globally. So it's a relatively as I say, immature market, despite the fact it's been around for 40 plus years in terms of overall sort of growth and development. And that means that we've seen, really explosive growth over the last sort of 5 years. And I'd say that's been driven, primarily by larger corporate companies who've started to see sort of flexible spaces maybe slightly more strategic, and helping them drive those efficiencies and agilities within their real estate portfolios, and moving away, or not just focusing on the smaller, the startups and the SMEs who maybe that's where sort of co-working has been synonymous with. But in terms of sort of the supply and demand, what we're seeing, it's really quite fascinating. So, we've seen since COVID, at least, a relative slowdown in the growth of supply. I think that's probably partly down to some hesitancy from the investment market in commercial real estate as a whole. But on the flip side, we're seeing demand levels really massively accelerate from where they were, which is creating some really interesting sort of dynamics in different global markets where you're starting to get supply and demand imbalances, with demand starting to sort of outstrip the supply, certainly from a growth perspective. And I think, that analogy I made from a speedboat and an oil tanker is something that, it relates to, I guess, the reaction, or the market reaction to different macroeconomic trends, and that's what we saw during 2008, during the financial crisis, and we've seen during COVID, which is due to the flexibility of the contracts and the shorter terms, people are able to move out and leave those spaces that don't necessarily work for them at that exact moment in time for whatever reason, although it's not as flexible as maybe outsiders may think. But at the same time, you then get a real inrush of new demand and new interest caused by periods of theoretical pain or in economic pain or business challenge. So what we're seeing, as I say, is growth rates of getting up for, I think, 39% or 32%, sorry, compared to 2019 at the moment within the flexible workspace industry from a demand perspective. So really strong.
32% above the 2019 level.
Correct. Yeah. So and from a commercial real estate perspective, that's probably pretty unusual given today's market. But as I say, that speedboat, oil tanker sort of analogy, it's just, you see the impact and the reaction to change far quicker, both negatively but then positively also.
Yeah. So okay. So just to unpack that a bit. So essentially, what you're saying is the immediate impact of the pandemic was cancellations of flexible space quite quickly. Some companies obviously looking to save costs. Businesses are being shut down, etc. That's, if you're on a short lease, that's something you can do. But actually, what you found post-pandemic is businesses are realizing they want more flexibility, and that pushes them towards your side of the market, basically.
Yeah, absolutely. I mean, as early as sort of early 2021, we saw really strong return to growth, and as I say, at the moment, the market's 32% ahead of where it was pre-pandemic. Now, not every market's reacted the same way. Again, supply and demand imbalances and various different working trends are impacting that. And again, that's something that you see quite clearly within this market because of its relative sort of flexibility. But yeah, it's really showing some interesting trends compared to sort of what we're seeing or reading in the traditional real estate sector, which appears to be going through quite a tough time, relatively speaking.
Well, let's come back to the traditional in a sec, because that's the compare and contrast. It's so interesting. But just sort of, this is an impossible question to ask, but it's quite interesting to see what you think. How much market share can flexible get to? When do you think it might be a mature market?
As you say, it's a difficult question to answer, and there's a number of sort of different theories out there. I mean, the one that we as a business, and I think a number of others, sort of look at is the 30% sort of figure. JLL, I think, famously sort of stated 30% by 2030. whether we'll see that
It's
or
good
not.
soundbite.
It's
Good
exactly,
soundbite.
it's a great soundbite. But I think, you know, that sort of percentage is wholly possible in the near future. I think what that sort of percentage, and when you unpack it, what it looks like maybe is slightly different to what we maybe see as co-working or flexible workspace today. And we'll probably see much more sort of landlord driven space or provided space, which probably fall somewhere in the middle of what we now call traditional and what we currently call flexible. I think that'll become an ever bigger part of that, providing to that corporate need that we certainly are seeing, you know, have seen dramatically increase, as I say, not just since COVID, because a lot of those trends are already, you know, starting. It's just that's really helped accelerate, I think, some of the thinking by larger corporates and you know, SMEs as well.
Yeah, so you mean the pandemic's almost changed mindsets of the people in companies?
I wouldn't say it's changed.
Decisions.
I wouldn't say it's changed the mindset. I think it's helped put focus on real estate as a whole, commercial real estate, and therefore maybe some of the conversations that were being had in a slightly more theoretical sense have suddenly come into sharper focus. And I think some of the maybe the reality that did exist has kind of, as I say, has now become clear, whereas before it wasn't something that was necessarily thought of or looked into in too much detail.
Yeah, so it's almost sort of got management over the line in many instances. They were heading that way, but pushed them over. So that's very interesting, and it strikes me. And what we often say in financial markets is that sort of in commercial real estate, there's a structural trend hitting at the same time as there's a cyclical trend. So let's just come back to the cyclical stuff in a minute. But if just thinking on that structural side, do you this whole work from home debate, do you have any sense of, because it seems to be ebb and flow, you know, 12, 18 months ago, all tech companies in the US seem to want no one in the office, and banks and finance have been quicker to get people back. But I get this sense, this could be completely wrong, that more and more companies are trying to encourage people back into the office. Do you have some sense on that? Is it different by geographies, or is the UK different from the US or the rest of Europe, or any sense on where we are with that?
No, I mean, broadly speaking, we've been speaking to our clients throughout the pandemic and since, and I think you're right. You know, there is a broad sense that the majority of companies want employees back into the office in some format. What that format is, that's up for debate. I think you know, depending on your sector, you mentioned finance, there's clearly slightly more sort of stringent expectations there, and actually the same for many of the larger tech companies now are going down that route actually as well. So I think that's, you know, broadly speaking, a given now for the majority of companies. In terms of, you know, what that looks like at a regional level and how that's being enforced, I think that's the key challenge at the moment. Depending on your jobs market and your sort of economic broader cycles and environment, ultimately that's then up to local managers and HR teams to enforce or manage. And I think that's the challenge that we see at the moment, is companies not maybe being quite willing to do that, or not wanting to simply.
You mean not willing to push their staff to commit? Is that what you mean? Or...
Yeah, I think so. You know, as I say, I think the majority of companies that we speak to are wanting staff back in various different levels, with various different expectation limits. It's are they actively enforcing that, or is it being left up to sort of local team managers and directors to effectively drive that themselves?
It sounds like the sort of thing you need a recession to change people's mindset, and they realize they've got to go to work because they need to keep their job.
Yeah, I mean, that could well be it. I mean, you know, one of the markets that we're hearing is the toughest to get people back in is the US, and traditionally that's been a market where actually, from a real estate perspective, it's probably had the best attendance, one of the strongest attendance, putting the Asia sort of markets aside, and I think that is simply because the jobs market there is very strong. Employees feel like they're in a relative position of power now. maybe starting to change with some of the news that we're starting to read and see. But I think broadly speaking, that's still the case. And I think there's also been, in markets like the US where they traditionally have had very much of an office culture, it's been almost a bigger eye opener than in places maybe like the UK where individuals were already working at home 1 day a week, for instance. And therefore it hasn't been quite as groundbreaking when we did all work from home for periods of time during the pandemic. So yeah, the US market is certainly a challenging one. I think partly that is down to, as you say, the economic climate, but we may start to see that change. Only time will tell.
Interesting. So so that's the sort of the sort of structural overview. It's clearly it's a small share of global real estate, as you say. It's emerging, and everyone seems to have accelerated over the last couple of years, and looks like it's heading towards, whether it's 30 at 30 as JLL suggests, or 20 at 30, whatever the number is. It's clearly a growing market and growing quite fast, as you articulate. So structurally, that trend seems in place. It was very interesting, just that maybe the segue us into the sort of cyclical stuff. It was very interesting, the observation you were talking about demand and supply at the start, and the fact that demand growth is very high, but supply isn't. Well, because naturally one would think, well, there's a lot of commercial real estate that's old school, traditional stuff that will come up and therefore be transformed into flexible working space. But I suspect you're going to tell me that actually that stuff isn't the right kind of space. Is that correct?
Yeah, I mean, it's interesting. We were talking to an asset owner this morning on this topic. I think there's challenges ultimately when it comes to sort of investment, and it does require investment to turn a large Cat A or Grade A floor plate into something that is suitable for or delivers in a flexible sense. As I mentioned at the beginning, there is an investment there needed. And that, I think, is something that most asset owners at the moment are cautious of. Increasing investment is not something that they're looking to do necessarily, unless there is a clear return on that. And that clear return, particularly whether from a revenue perspective, is easier to see, but when it comes to sort of capital values of those assets, that's still something that's quite challenging. And I think that comes down to lack of clarity and opaqueness within the market from a data perspective. The market traditionally has been quite sort of closed and cautious around showing its performance, simply because most companies have been in really high growth phases, and therefore everyone's seen as a competitor to a certain extent. So companies such as ourselves and coworking Intel, which is a data platform that we have as a business, have invested in. That's what we're trying to change. We're trying to bring some clarity to that market, because from our perspective, only when you kind of start opening up from the data perspective and giving investors clarity, will that investment start happening and start becoming more readily available. I think alongside that, the majority of asset owners are still, their preferred route is still a traditional lease. It's what they know. It's what their investors understand, and ultimately they see it as a safer option. And I think it's only, when, not in all cases, but for many, it's only when those assets are becoming slightly more distressed do they start looking at non-primary options, of which flex for many traditional asset owners is such a thing. Now there's others that have been kind of going down the flex route pre-pandemic and are fully bought in and are opening up and expanding quickly. These are, I'm talking about asset owners and landlords here. So you've got two schools of thought there, I think. But what we're seeing at the moment is asset owners coming to us looking for, can you provide clarity on what my revenues could look like? What is the demand? Is this what's the risk profile of doing this ultimately? And does that work with my models, my existing models, or do I need to rethink? I think the challenge is that, as I say, for many flexible spaces, they're looking at slightly smaller tenants, although that is changing. And that means you need to invest quite heavily in floor plates that traditionally haven't been designed for that, which, as I say,
Yeah.
requires a CapEx investment, which is a
So
challenge.
part of it is the lack of ability to model what your revenue stream would be, because the lack of data in Flexi World that you guys are hopefully addressing and addressing with all the investment. The other part is the building's just not set up right, or it's in the wrong location, or a lot of the buildings that come on the market now tend to be the lowest quality. So are they very expensive to is that the point? It's a refit cost, or it's a location problem?
Well,
Or...
I mean, I think it doesn't matter what sort of part of the commercial real estate market you're looking at. There is clearly at present a drive for quality. And you can see that if you look at sort of the rates that people are paying for those super prime sort of assets. And it's the same in the flexible world. You know, the highest quality spaces with the highest level of service and the highest level of fit out are certainly performing very, very well. That's not to say actually that the other end of the market, the more economic, there's also quite strong success actually happening at the moment. But ultimately, if you've got an asset that starts out and it needs a significant level of investment to bring it up to even a basic standard, then that is a far harder financial proposition. I think, and what we started to see certainly during the pandemic, but it's still happening a little bit now, which is people are coming to us with assets that are not always, they're struggling commercially in the traditional sense, and they're hoping that sort of flex might be a silver bullet to that. And I think, ultimately there are companies and asset owners and individuals that are going to have to be sort of realistic or increasingly realistic that certain assets in the market today are going to struggle in their current format. Certainly in the short term, just because of the way office occupancy trends are going, whether that's in flex or traditional.
Yeah, so you mentioned office occupancy trends, that's interesting. We talked about the idea of the structural and the cyclical forces coming together, and obviously with the banking crisis in March in the States, there's a lot of concern about tightening lending standards in the US banking system. And some of that feeding over, we're seeing tightening lending standards in the UK and across mainland Europe as well. So how is the traditional office real estate market faring? How would you paint that picture if you were to characterize the US, the UK, mainland Europe? How would you see each of them faring at the moment? Are there any differences, or is it a similar trend across all those markets?
Yeah, I mean, I'm an outsider to a certain extent looking in, and I'm reading and seeing what is being sort of talked about, but also we're hearing it from landlords who, as I say, are coming to us and looking at the flexible market as a increasingly viable option to supplement revenue streams that they may have seen from traditional leases as well. And I think ultimately for many markets it's pretty tough. If you're looking at the US, we've seen a number of relatively new, relatively decent quality assets being handed back to their sort of financial backers. I think we've seen 2 in Canary Wharf in the last couple of weeks go through the same thing. So I think there is an increasing.
Why are they being handed back? Are they being handed back because there's just not the occupancy? It's just not viable.
I couldn't comment exactly on why they're being handed back. I mean, my assumption would be that that you are seeing a lack of demand for some of those spaces, and therefore from a revenue potential perspective, they're just not meeting their expectations. But I think if you look at any of the data coming out of any of the large providers, the CBREs, the JLLs, whoever they may be, from a vacancy perspective, in many markets, it's at the highest levels that they've ever been, and they're only increasing. You've got places in the US with vacancy in the high 20s. You've got places in the UK where it's in the high mid to high teens. So it's getting to a point where yeah, I think it's starting to become problematic financially, which is why, as I say, we're seeing one of the reasons why I think we're seeing more asset owners look at other avenues for revenue generation, and flex being one, particularly as it's able to generate normally higher revenue than a traditional model.
What do you make of the idea? I mean, I was looking at some commercial real estate charts, sort of price total return charts in the States the other day, going back sort of 15 years, and they all had sort of steady ascents post global financial crisis, and then many of them accelerated upwards in the different segments of commercial real estate, not just office, retail and warehouse and industrial. Many of them sort of accelerated, some of them even doubled sort of around the pandemic time. What do you make of the idea that ultimately real estate's a fixed income return product with a bit of capital appreciation, if in line with, perhaps theoretically probably in line with normal GDP growth? So what do you make of the idea that actually cheap money accelerated that capital appreciation, at a pretty rapid pace in parts, and therefore now that we've repriced base rates and cross yield curves, government bond yields, you've got to reprice down the asset price, given your risk-free rate is much higher. What would you make of that?
Well, I mean, in terms of sort of downvaluing the capital values of some of those assets, I mean, I think that is something that we are starting to slowly see. I come from a background outside of real estate before sort of joining the Instant Group, and I think it's one of the few markets where sort of values are established really based on neighboring precedent to a certain extent, and what I'm seeing right now is asset owners not refusing but choosing not to sell assets for the fear of seeing a devaluation, but unless they sell that asset, then on paper, or at least if neighboring assets also don't sell, then on paper nothing quite changes, and that's quite a strange principle sort of to me, as I say, coming from other markets and industries. So, but as I say, I think we are starting to see that happen. There's examples in Germany, there's examples in the US, there's increasing examples in the UK, but also they don't seem to be talked about anyway in too much detail in the real estate press, probably for obvious reasons. But yeah,
they do what they don't get talked about much.
No, I mean, you tend to see the positives, as in any sort of any industry, if you were sort of reading top line.
Don't bite the hand that feeds you. So what sort of marks down do you have any sense? I mean, it's obviously difficult to get hold of the data. Is there any sense of how much these buildings are being valued, and the few that are being marked and sold?
No, I mean, I don't personally have sort of an exact idea on that, and I don't think I could probably comment, given I'm not involved directly in that area, to be honest with you. So I'd love to give you a figure, but unfortunately, it would be high in the sky.
It's fine. We don't expect you to if you can't comment, you can't comment. But so it's interesting how you describe it though. So because it's a bit like, I think for most people, the analogy would be the housing market, and we all buy and sell our house, a few times over our lifetimes, maybe even more. And we all know what the estate agent does when they come to value it. They look at all the houses around the corner and see what they've gone for, and they sort of add a bit or take a bit off, depending on if they think the market's really hot or maybe it's a bit soft. But often it's really the process of. So in a sense, what we're saying in residential and in commercial is the market drives the price, and if there's no activity in the market, no one knows what the price is, basically.
Essentially, yes. I mean, I think with residential, and it's not always the case with rental properties, but you can assume that if someone buys a property, they will occupy. I think the difference that we're seeing in office right now is there's a concern around that occupancy ultimately. And therefore that's what's creating questions. That's always been broadly speaking a bit of a given. So that I think is, it comes down to utilization and occupancy.
It's interesting you mention that, because you've already mentioned that vacancy rates are at high levels, and of course, really just to make the distinction, vacancy rates means no one's paying for the lease, basically. There's no one in it at all. And I think the other part of the conundrum is what you just articulated, occupancy rates. And this, I think, is where the structural part comes into play as well, as I understand it from our discussions before. The occupancy rate was quite low coming into the pandemic. And I think you're suggesting that managers of office space and companies, and I don't want to put words in your mouth, so tell me if this is wrong, but they're coming to the conclusion that they don't need such low occupancy rates. And
yeah, I think it's more. I would probably term it as utilization of space or physical occupancy. So it's the number of people you have bums on seats ultimately. And yeah, I mean this is certainly my viewpoint. And speaking to occupiers and looking at the market, but for me it appeared that. I've heard this from companies that when they were looking to acquire real estate, commercial real estate, they would go in with the mentality of what's our company's growth going to be over the next 10 years, let's say 20%. So I will take a space at 120% of what I am today. And actually, I'll probably add on an extra 10% to be safe. So they're at 120% of, theoretical capacity or utilization. I think in reality, what you actually saw was when you take into account people on holiday, people in sick leave, people that are out with clients or whatever it may be, that actual true sort of physical occupancy was probably only at 70% at best, potentially down to 60% in many businesses where they had lots of people out, on the road or with clients or in different locations. So what we've got is I would say maybe an exposure of that, and therefore companies realizing that if they were at 130%, they now need to be at 70%. Well, that's a pretty big gap, and even if they were at 100% and they now need to be at 70%, well, that's still a big chunk of space. And I think that's what we're starting to see as lease events come up and it's not for everyone, and there's still companies in high growth phases that need more space, and there always will be, but for many of those companies that are sort of larger in slightly steadier states, I think they're looking at their real estate portfolios at lease events and really thinking about actually how much do we really need, and again that plays into the flexible and agile workspace market, because ultimately that allows you to react far quicker to changing needs, whereas the traditional model hasn't. Hence why businesses have had to hedge effectively.
So there's kind of two things going on. There's the idea that people are happy to work from home, so you can have much more sort of hot desking. That's becoming, I think, more accepted in companies. So that allows less space. And then there's the idea that even if you think you need a bit more over the next few years, you don't have to worry, because you can always temporarily get some flexi space to cope with your overflow if it becomes an issue in the office. Is it kind of two structural trends at work, really?
I think that's a fair assessment, and we're starting to see some of the large new assets that are coming into the market cater to that by having a provision of flexible space in their buildings, with an understanding that a traditional tenant will still make up a large percentage of that building, but they will want the ability to overflow if needed. And I think that's the changes we're starting, or that's one of the changes we're seeing asset owners kind of starting to come in with that mentality and an understanding that element of service-led space, as it were, really delivers not just direct revenue and value, but also it's an attraction to your traditional tenant as well.
So it makes a big impact. It means that a company that is rethinking its sort of space, a big multinational corporate, instead of having to expect a 70% occupancy rate, can aim much closer to 100, basically, and also make the assumption that people are going to be in and out the office. They might be out of the office 2 days a week, working from home or traveling. And if you bring in some flexibility in hot desking, suddenly your space requirement is very, very different, I would have thought, from
it is. And I mean that's ultimately what we're seeing from companies that are having that realization and trying to figure out right now how do they what's their strategy to respond to that. It varies company by company, but I mean, in the extremes, we are seeing companies make the decision, and I won't, name names, but make the decision to effectively buy themselves out of leases, because they accept that those are just not going to be needed for the duration of that lease, and therefore it's better to get it off the books, as it were, and have no liability over that.
Yeah, I think I saw a stat on subleases in the States that there was a lot of empty subleases space around that had gone up a lot. So do you think, I mean, there's clearly some structural and cyclical at work here. Do you think if the more America goes into a downturn, and the recession looks like it's coming towards us over the next few quarters, does that accelerate companies' desire to do this? Do you think, I mean, clearly if revenue's under pressure, you want to cut costs, this must be one way to do it. Do you see any of that, or would you expect that to come?
Yeah, I mean, I think we're already seeing that. Again, there's a realization of a lot of companies that real estate is one of their top costs, if not, one of the top two costs after employees. Again, depending on your sector. But that I think, has shined a spotlight on the overall cost of the real estate infrastructure that a company has. And therefore, if you're trying to cut costs, that is certainly one way of doing it, particularly if you see that you've got excess capacity. And I can see that being a factor. I think if we look at sort of the data and the research that we've done, ultimately the primary driver right now isn't cost for employees. It's actually getting my employees back in, using the space in the right way, engaging with colleagues. So it's utilization is the primary factor. Cost is sort of 3 or 4 down on the list. Again, it'll depend on the company, obviously, but that's the trend that we're seeing. I mean, if we see a significant downturn, then maybe you will see more stick than carrot in terms of getting employees back in, and equally you will see companies take a harder line around downsizing sort of real estate or becoming more flexible and agile in what they do purchase, so sort of protecting themselves in the future. But yeah, I mean, it's interesting if you look at sort of some of the transport data, which nominally you can sort of infer around sort of attendance and compared to pre-pandemic, and you look at Seattle, for example, as we're reading today, their transport, public transport's down at about 50% of pre-pandemic levels. In New York, the subways it's still, I think, about 61%, according to the New York NYC transit data. So there's still significant amounts of employees theoretically that are not coming in to their offices on a regular basis. Interestingly, if you look at the UK, London as an example, the TfL actually it seems to be at about 90% of pre-pandemic, but offices certainly don't feel busy on a certainly Monday or Friday. So again, there's some interesting things there that you can start to look at and again infer what may be happening in the market.
Yeah, but 90% in the UK seems weird because everyone talks about UK offices being quite empty, but maybe I don't know how you marry that up with the 90%.
Well, it may be that they always were a bit empty, but we just didn't focus on it. All those individuals are going into other spaces. Maybe they're working, they're going to events, or I don't know. But yeah, it's an interesting one when you look at those stats. Obviously, transport isn't related just to office workers. There's a wider population base there. But yeah.
Do you look at San Francisco at all? Because there's a lot to chat about how that's really suffering as a city in terms of people not going into offices and downtown space and business district space and retail being under a lot of pressure as a result.
Yeah, I mean that was one of our stronger markets pre-pandemic. Positive growth. A lot of obviously tech companies there expanding and looking at new ways of working and wanting the best environments, which often flexible space is able to deliver. So yeah, I mean it's been a focus for us, and we have people on the ground out there. I think it's an unfortunate collision of scenarios really, where you've got a huge number of workers that have moved out of the cities throughout the pandemic to back to original home locations, and are reticent to come back through property prices and whatever else, living costs. You've got a lot of office space that was probably acquired speculatively by large tech corporates expecting very, very high growth. Maybe not all of that is needed now. And then you've also got this, I guess, socioeconomic problem, which appears, which we hear reports of large amounts of sort of homelessness now in the city. Again, it was probably always there, but was it sort of compacted into the downtown areas? Possibly not, which is creating an environment that even if people have offices, they don't want to go to them. And then you start, it's a bit of a snowball. It has the potential to be a bit of a snowball effect, which is if people aren't going in, they're not spending their money. If they're not going in, do their companies need office space? So they may take less, and then your taxes decrease. And so there's a real, cyclical potential problem there. And I think it was mentioned in New York, actually, there was a shortfall. I can't remember the value, but it was in the hundreds of millions, a shortfall in commercial property tax through companies exiting space during the pandemic, which it was a staggering number, which that then leaves a hole in the local government.
Harder to provide other services.
Yeah.
And we also hear a lot of stories of companies moving out of California in general and relocating to Texas or Florida because of the better tax regimes and better flexibility, and actually more affordable for their workers to live in those places than
it's not all doom and gloom. I mean, you've got some fantastic markets that are absolutely flying. You mentioned parts of Florida, Miami, Fort Lauderdale. You've got Denver as a market. You've got in Texas, you've got Houston and Dallas. I mean, some of these markets are absolutely flying and really, really strong, certainly flexibly, but I think also traditionally. And it's it's a bit the same, I think, in some of the secondary markets in Europe and the UK. Certainly from the flexible side, we're seeing very, very strong growth in those markets, and really strong increases in demand. So it's not all doom and gloom. It's for sure. It's just people are looking at different options.
Yeah. How would you say this whole big picture is playing out in mainland Europe? If you look at cities like Frankfurt, Paris, Madrid, Milan, Stockholm, some of the more international cities, if you like, in mainland Europe. Are they adopting a lot of these trends? Have they got a lot of challenges in traditional commercial real estate? Do you have any sense on those, or any that you focus on?
No, I mean, as I say, we operate globally, and we have teams in some of those cities that you've mentioned. And I think what we're seeing is maybe not quite as strong a challenge, shall we say. I think the employee return to the office is slightly more positive in some of those cities. I think there's also, if you look at some of the European cities, you're just the way they've been built up, you don't necessarily have the same concentration of office space in the centre. Paris, you've obviously got the La Défense on the edge, but centrally it's far more sort of diverse. And the same could be said for German cities and some of those in Eastern Europe, which is you've got a more equal spread in terms of residential and office. It certainly feels like that, looking at it. Others may argue with that point, but I think that means that you don't have this same commuter culture that you have certainly in the UK and in parts of the US.
Yeah, it's very concentrated. I mean, London's a great example where people come, they commute an hour and a half, 2 hours out to get into town, which is really, I mean, you don't get that. Germany's got more sort of large-ish cities, but not mega cities. And so the commute's often easier, I think, isn't it? It's certainly the impression I get. So we've got some cyclical challenges. We talked about high vacancy rates, and then you sort of lay on all these structural challenges. I guess there's one other issue that we need to touch on, which is sort of mega long term, which I think is probably relevant here, which is the idea that we're talking about climate change and being green in terms of buildings, and and actually old buildings needing a lot of investment, or actually perhaps not even being viable in this new world where you're trying to make them compliant with various countries' green necessary required green rules and protocols, or whatever it is. Is that correct? Is there a lot of real estate out there that essentially is not transformable to this new green world that we're going to live in?
Yes, I think is the simple answer. I mean, certainly, if you look in the UK, where you've got very clear sort of levels of ratings that I think I can't remember the stat off the top of my head, but there is statistics out there that show exactly how much theoretically will not be viable from a leasable perspective when the new legislation comes in.
2%, 20%?
No, as things stand today, it's well over 50%. I think by 2028 is when one of the
over 50%
final
of and that's a UK.
Yeah, it's a huge number that theoretically becomes non-viable with current sort of categorization. So and I think that creates again a whole load of sort of investment, obviously difficulties, trying to predict whether that legislation changes or if there's different ways of bringing those buildings up to standard. But yeah, so I can't remember the figure exactly off the top of my head, but it is quite a staggering number.
Yeah. But I understand it can change, legislation can change, and ways even so, it's still a very big number.
It's a big number, and it's not just sort of legislation. If you look at the occupiers, obviously it's at the moment a lot of the large corporates which are sort of driving this through their mandates and their commitments. But that's starting to have a knock-on effect to their supply chain. So it's not just the corporates, it's the SMEs and even the startups who are needing to be able to provide data and reassurance back up their supply chain that they are complying, and office space is a big one. So I think at the moment, when we again last ask occupiers and providers of space where it is on their priority matrix, it varies, but when we ask that question year on year, it is quickly increasing. And we recently did some research with the ULI, talking to operators, providers of space, landlords and occupiers, and we specifically asked around sort of sustainability and environmental sort of governance and investment, and the figure that stands out was just 2% of the asset owners that we interviewed felt that they had the capex budgeted in place to deliver the requirements that they expected their occupiers to need in the next 5 years. So I mean, there's again, it's a staggeringly small, percentage that feel like they had exactly what they'll need, there and ready, or at least budgeted. So again, there's potentially some big challenges there.
Some big challenges, or a lot of capex, or a lot of buildings that need to be changed. So, as before we conclude, let me just ask you a sort of out of the box question. You work in real estate in the broader sense of the term, and you work in office space. Is it? I mean, I was always struck. It's the Italian offices where they have all that greenery up the side, and I've seen one or two in Singapore. Do you have a sort of favorite office space or building that whether it's the Shard or the whatever it is in, I forget what it's called in Abu Dhabi, in Dubai, is there something you? I mean, since you're in the space, you might have.
I mean, I'll be honest. I'll be honest with you. I'm not an architect, and I'm not an interior designer or designer. So I probably don't get excited in quite the same way as some would. But for me, and I'll use our office as an example. We're on a relatively high level. We've got a lot of natural light. There's a lot of greenery in there. We've got fantastic views across the city and out across the Thames, and it's a really enjoyable place to work, which makes me want to go in there. I think we've had calls. An example, we had calls during pandemic where we've been talking to heads of real estate, corporate heads of real estate, where they've been saying, look, we're struggling to get people back into our office, and they're sat in, strip lighting type cubicle type space, and you kind of go, well, I'm not massively surprised. So does a particular building or office excite me? No. For me, it needs to be stimulating, and it needs to have vibrancy, and that can be done through service level. It can be done through, as I say, light and furniture and fit out. But I think that is really critical. These days. More plants, more light. Yeah. It creates a far nicer environment that we all ultimately want to be in. From my perspective, anyway. Others may have a different view.
I love that. Mine was the building in Singapore, but I'm not much of a building nerd either. James, thank you so much for your time. I really appreciate it. It's been fascinating. It's quite fascinating to hear what's going on. I think in terms of financial markets, it's such a key issue in the way it feeds back into the banking system. So I really appreciate all your insights.
No, it's been great to talk. I mean, from a summary for me is there's a lot of challenge ahead for the commercial real estate sector, but also a huge amount of opportunity. Certainly in sort of the areas like that, as I say, that the Insta Group are working in and I'm working in, and people are genuinely excited about what the future holds, which for me it's a fantastic environment to be in. It's a fantastic sort of segment of the industry to be in. So as I say, there's some really exciting opportunities out there in potentially a tough market.
It seems like you're in absolutely the right space in commercial real estate, and as you say, it's going to change a lot over the next 10 years. I've certainly got a good sense of that from this conversation. And as you say, lots of opportunities, but also lots of challenges. So thank you for your time, James. I appreciate it.
No, thanks, Chris. Great to speak.
Thank you.
Bye.